Everyone thinks war pushes oil prices higher. Less supply, higher prices, simple. But that's only the first layer of thinking. What happens when destruction spreads beyond oil fields? Ports shut down, shipping routes break, raw materials stop moving. Factories don't just slow, they stop. And when factories stop, demand for energy collapses. No production means no fuel consumption. No transport, no logistics, no growth. We've seen this before. In major crises, demand destruction can hit faster than supply shocks. When the global economy slows, energy demand doesn't just weaken, it falls off a cliff. This is where the narrative flips. Oil is no longer driven by supply shortages. It's dragged down by collapsing demand. In extreme scenarios, demand destruction outweighs supply disruption. That's when oil doesn't spike, it rolls over. Markets don't just price events, they price consequences. And if the consequence of war is a global slowdown, oil may not go up at all. If you want to understand how money really moves, follow capital theory.